Hey, Chris was in our speed round last week, and he gave us Nike. And I looked at it and I said, "Oh my gosh, this guy must have done a earnings play." So I called Chris over the weekend ahead of the winter holidays, and sure enough, he did. And I recorded an interview, which we will probably release. But let me give you some insights. So I'm looking at Nike here. In fact, I'm going to zoom in. This is so if you've tuned into our show in the past, you know this about me. If you're new to the show, here's what I like to trade: predictability. So going into an earnings play, what's predictable? Not much. But there is one thing that is predictable, and you have to think outside the box. What's predictable is going into earnings plays, people are going to be uncertain. And then after the earnings announcement, people, return to business as usual. And if you know anything about options, options can profit on uncertainty versus, confidence, which is, the before and after. That's what's predictable about in earnings, is that before the announcements, there's uncertainty. After the announcement, there's confidence. And we can turn that into a trade. And so that's what Chris did. He bought to open on the evening. Let's see, what did he tell me? Thursday, December 19th. So you see this earnings right here on our chart. In fact, I'm going to zoom in even further. I'm going to zoom into 1 month. You see this earnings on December 19th. This was after the market closed, right? So on December 19th, before the market closed, in fact, he did it at 3:30 in the afternoon Eastern time. So the market closes at 4. So he came in a half an hour before the market closed. A- Excuse me. And he bought the Nike calendar spread. He used puts, and he did the uh, January 25th weekly option, January 24th, 2025 weekly option. That was the back month, and he used the December 27th front month. So he created that calendar spread, and he bought these things for 48 cents each. So you buy these spreads in lots of 100. So he spent $48 for every contract he bought of these particular calendar spreads. Again, the two options, it was all the $77 strike price. They were all puts, and the two options in the spread, a calendar spread has two different expiration dates. The back month was January 24th of 2025. The front month was December 27th of 2024. So he created these calendar spreads, bought them for 48 cents. The next day after earnings was released the night before, he came in and at about 11:19 in the morning. So the market opens up at 9:30 in the morning. So through the first hour and then, into the second hour, he went ahead and sold these things. Guess how much he sold them for? $1.19 a piece. So he bought them for 48 cents a piece, and he sold them the next day, just held it overnight, allowed the confidence to come back after all that uncertainty, sold them for $1.19 a piece. He made 71 cents per share in profit on a 48-cent investment. If you do the math, that's a return on investment of 148%. So for every dollar he put in, he got $1.48 back. That's pretty amazing for a trade. And this is not considered a day trade because he did it the night before and got out of it the next day. So there was no limit to the minimum amounts he had to invest. What a fantastic trade. I give Chris kudos for following our instructions to the T.
So I have a quick question follow up on that. So 148% return sounds fabulous, but what does the negative look like? What is that risk, or what could you potentially lose that makes that 148 so, appealing?
Well, I'm not sure that it's as much of a loss as it's more of a, it could be a break even trade. And so what happens here is if there's any, you'll notice that the price action, this bar on the 20th was not much different than the bar on the 19th. I mean, if I go to my options lookup tool and I put in our ticker symbol here for, he did Nike, NKE, and we go back to the 19th. So I'll let this load up here, and I'll go back to the 19th, and I'll let it load up again. So the two options that he did was this December 27th, and he did this January 24th. And he did the, let's close all these. He did the $77 put. So you'll notice that here's the December. It was going at the end of the day. So these are end of day prices. He used kind of the daily prices. The front month option was going for 365. And then on the next day, we wanted to go down in price. On the next day, here it comes. On the next day, it went from 365 down to 85 cents. That's absolutely fantastic, right? So you were asking about the downside. Just as a side note, the back month option, it on the day after it was $3.10. We don't want the back month option to change very much. So if I go back to the 19th, we're going to compare $3.10. The day before, it was $3.61. So this guy dropped, 41 cents, but this guy dropped like a whole bunch. This guy dropped like $2 or whatever the amount difference is. And that's what you want to create, is that difference in spread, because you know that those front month options will drop in price when confidence returns after earnings. And that's basically very reliable. Now, you were asking about, what could be the downside is if we get some sort of price action where when we're screening for these symbols, we look for symbols, we look at the previous earnings, and we look for symbols that are kind of boring at earnings. He played this, and some of the earnings are nothing burgers. Some of the earnings are not. I think Chris was following Nike's news headlines, and he was telling me, Nike looked like it was just going to be not really impress anybody during earnings, but also not piss anybody off. So he did this trade. But if there was some sort of pop or drop in price, it just reduces your gains. So you usually do these trades in mass. You do a bunch of these earnings trades, and the ones that don't move in price, I mean, they can double, or in the case of Chris, his more than doubled. It almost tripled in value. But if they do move a little bit, well, then, you might break even.